have Z here to interview him about his latest findings and analyses. Z is a senior analyst at Glassnode, and he's one of the best on-chain analysts that I know. So let's get started. Today we have an amazing set of charts that he has prepared, mostly focused on measuring the sentiment of the new Bitcoin investors that have entered the market. If you've noticed in the last few weeks or months, Bitcoin has significantly gone up. And actually, when you look at the data, when you look at the price numbers, we see incredible performance. Bitcoin has gone up by 140% since the beginning of the year. In the last month, it has returned 13%. In the last week, 9%. Last 24 hours, 2%. Significant pump. A lot of new money, a lot of new investors. You can feel the positive sentiment in the market. But the question that we're going to answer today is whether the new money that has come to the market, whether it's resilient, what is its sentiment, and how confident they are in the trend, which impacts their behavior. Hi Z, welcome.
Hello. How you doing?
Very good. How about yourself?
Oh, I'm doing great. I'm glad to be here again with you guys, and I'm ready. Let's get into it.
Awesome. So, yep. What do you have for us today?
Well, as you perfectly opened the discussion, recently we saw like market showing some shift in sentiment. So we thought, okay, let's give the audiences a tool, especially using on-chain data, that they can use it to actually quantitatively answer this question. How are the new money reading the market? Is the new money interested or confident in trend in midterm, or no, they're losing their confidence? So as a consequence, they're stopping deploying new capital in the market. Literally looking at the demand side, sentiment, confidence, these are usually some subjective, there is some subjective definition for them. But today we want to bring numbers. We're going to show you chart how you can use on-chain data to measure the confidence of new investors in the trend for short-term to midterm. That's what we're going to do today, and I'm excited to get into the charts.
And the reason that's important is a lot of the market movements is determined by the behavior of short-term investors. So it's really important to understand their psychology and their sentiment. So I'm going to share your slides. Let's go.
Yes, a great teacher told me if you want to start a conversation, especially on-chain, which it could get boring really fast, start with saying what you want to say, then say it, then do the conclusion and say what you just said. So I'm going to start to show the people are watching this video now and in future what we're going to actually bring to your attention, like what we're going to show you. At the end of this video, this session with Sina, we're going to show you an indicator like this one. The green and the red always is just interesting to everyone, but there is a meaning into this. The green in this chart is going to show you when the new money, the new investor are overconfident. It measures the confidence of the new investors. When it gets super hot, it gets above a certain threshold. That means they are overconfident. That means they are too optimistic. On the other side, you see when it's red and it's too negative, it is showing they are too, they're undervaluing the market. They are capitulating. They are realizing too much loss. So we are measuring this change in sentiment by math, by using on-chain data, not subjectively come here and look at some chart and say, based on my opinion, they are losing confidence. No, we are going to show they are actually losing confidence. So this is the result after this session, but we have to explain how we measure it, what is behind of all these beautiful green and red bar charts. So if you want, we can start from the beginning. What are new investors? Who are short-term holder? What is long-term holder? We better start to define what is new money, what we call new money in on-chain data or in general.
So explain to us what is short-term investor, what is long-term investor, and how they are computed.
Lovely, sure. So as many of you might have already faced these concepts, short-term and long-term holder is a concept that been coined by Glassnode, and the logic behind of this classification is not subjective. It's not something that, okay, we call these investors our long-term holder, these short. No, by the math, the short description would be long-term holder are the investors who are holding their coins for more than 155 days or roughly 6 months, and short-term holders or new investors are the buyers or the people who acquired the coins in last 6 months. So why 6 months? Because statistically, we can share the article with everyone. Statistically, it's been proven the probability of spending your coin before 6 months is significantly higher than the probability of spending your coin if you hold it more than 6 months. So basically, after 6 months, there is a huge significant drop in the probability of spending, and it means like if you hold your coin more than 6 months, or statistically proven, whoever holds its coin more than 6 months, they become price insensitive. They look for a profit margin to exit. They don't care about short-term, mid-term movement in the market. So right off the bat, you look at description, you understand why short-term holders are important, because they are the one that are more price sensitive. The probability of spending among them is higher because they are new investors. Like psychologically, you just enter the market, you're more prone to look at the, oh, price is up, I should actually hold. And they are the one that actually sometimes do the wrong, make a wrong decision. So they are the one shape cycles. That's why the short-term holders are important. But for as a description, short-term holders are the investors that enter the market in the last 6 months. Long-term holders are the ones that entered and hodled their coin for more than 6 months. So to show what is happening every cycle, what is this short-term, long-term holder application? What we do that classification. Here you can see the blue line is showing the number of coins that are hodled and are in the pocket of the long-term holder. Again, on the right side, we can see the value. At the moment, they have around 14 million coin are long-term holder, and around 2.7 million is actually hodled, and the short-term holder are in charge of around 2.7 million coins. And as you can see, throughout the bear market, the number of coins that are in control, the long-term holder are in control of, they're growing. Why? Because more people are deciding or forced to be a long-term holder. The coins are actually moving from short-term holder classification. If they are staying dormant for 6 months, they're going to be a long-term holder. But during the bull markets, the long-term holders start to spend. See, their coins start to decline, and at the same time, the number of coins that are acquired by new investor is growing. You can see, like for example, in 2020 to 2021, before the rally, the short-term holder had around 2.7 million coin. At the end of the, close to the top, they had 4.6. So around 2 million coin was rotated that during that bull market. That means long-term holder had the opportunity to spend 2 million of their coins, and the new buyers came to the market and they start to buy. And that buying pressure, or new money, new investors get exhausted after a while. Obviously, they start to buy and buy, but the higher the price it goes, the less the ability of the new money to meet the supply side, the amount of coin that being spent by long-term holder, it becomes weaker and weaker. That's where actually the top being formed. But this, if just looking visually, you can see cycle by cycle, the number of coin that change hands from long-term holder to short-term holder during the bull markets is getting smaller and smaller. Like the recent cycle, if we say like early January 2024, let's say we call it the beginning of the bull market, the sharp bull market, sharp movement in price, they had 2.2 million. The new investors had 2.2 million coin in their pocket, but close to the top, they had 3.2 million. So around 1 million coin was changing hands during that bull market. But after reaching 74, you could see the demand side actually cannot did not meet the supply side. So the supply side, which is the long-term holder supply, start to grow. They start to huddle. So whenever the huddling or intention to spending reduces and huddling increases, that's when the long-term holder or the long-term investors supply start to grow, and short-term holder are not entering the market. They're not buying at higher prices. Their supply start to decline. That's the sign of their coin is maturing to be a long-term holder, or they're spending and getting out of the market. It's the combination of both. We can see starting almost May, the demand side was exhausted and the supply side didn't have the opportunity to spend at higher price, the price that they wanted to spend. So you could see the huddling started to show some effect in the supply rotation. You could see the long-term holder, the spending was happening up to May. Then after May, their supply is starting to grow again. But in last 2 weeks, you can see since I would say, in last 3 weeks, late September, when the market started to rally above 62, you could see the long-term holders start to spend a little bit, and short-term holders or new investors start to accumulate more coin. So the recent rally incentivized the long-term holder to spend again, and short-term holder actually stepped in and start to buy new coins. That is a good sign. That means the new investors have the appetite. They are interested to buy the coins while the price is going up. So that's why it's important. If you look at the short-term holder or new investors, supply growing, the price they're buying, looking through all these numbers, we can look at the sentiment. Are they interested to buy a coin at a higher price, or they are exiting the market at lower prices? So using these metrics, we're going to get into actually what is the sentiment, how interested they are in buying, or how desperate they are and they are capitulating. So the
So
next
one thing,
chart, yeah.
Before we move on,
Sure.
looks like on this chart, what I'm seeing is in the zoomed out version, the number of coins held by long-term holders versus short-term holders has the highest gap, almost the highest gap in the history this year. So a lot bigger portion of the market is now controlled by long-term holders. So the market is more and more adopting the long-term strategy, and short-term people had stopped buying as we peaked at the end of quarter 1.
Yeah.
But little by little, essentially they probably had a negative sentiment all the way to perhaps this month. But lately they have begun purchasing again, and that has been fueling the rally.
Exactly. That's actually what fueling the rally. They start to buy Bitcoin, and Bitcoin start to rally. Long-term holder who bought their coin, that's that red and blue. Do you see? When we say long-term holder, it means the ones that bought their coin in the blue the time range, and the red one is actually 6 months. This distance is 6 months. Is the one that bought recently. So you could see the long-term holder who bought probably close to the top or any time in history. You could see they're spending. So that's a good sign. They're spending, but there's new buyers buying it and price goes up. And the buying side is stronger because we are moving upward. If they were selling and price going down, that means, okay, long-term holder is spending on a little bit loss, and short-term holder, they're buying it, but they're buying it at a little bit discount. But right now they're buying at premium, and price is going up. So that's the beauty. But yes, the gap you talked about, most of it is because the nature and the nature of the investors changed. Like they buy and huddle. You could see across the network, the huddling is the dominant sentiment. Bitcoin is doing what it's supposed to do for many. That's being a store of value. You could see from this chart. Also, another factor that is causing this gap between short-term and long-term holder is something like ETFs and custodials, because in custodial. The big custodial throughout the Bitcoin custodials, the trade and movement happens off-chain. The coin is on some wallet, but the ownership is being exchanged. That's why you see there's one close to 1 million. I don't have the recent number, 700,000 to 1 million. I should look at it. Is owned by ETFs, but they're not. If I sell my ETF share to you, I'm not moving any coin on chain. So on chain, it looks like it's dormant, but I am spending. So I'm a new investor, I'm a new buyer, but it doesn't show itself on chain. But eventually, after a couple of months, when the ETF have their exit and enter the new money in their wallet, you see that movement. So part of it is because of the new way that we're dealing with Bitcoin throughout the proxies like ETFs. But the main reason is the change in the identity of investors from being fully a speculator to be a hodler. You could see the footprint of hodler is obvious via this chart. It's really
Also,
interesting.
ETF investors are on average a lot more disciplined, a lot more long-term focused, a lot
Yeah,
more, a lot less trading mentality. So,
yeah,
yeah.
yeah. It's interesting. So the second chart I want to show you, because all this chart I'm trying to use here is to justify why looking at the demand side is important, because there is unlimited amount of supply. That's how I put it. Like everyone talk about the balances on exchange. That's irrelevant. If the price goes up at the right price, there is always a seller. So don't worry about the supply side. Personally, I would recommend focus on the demand side. Is there a demand to buy? Is demand side exhausted? Is demand actually ready to buy? Like these things are much more interesting. The second chart I want to show you is trying to, because in the first chart we show, you just literally counted the number of coins it's controlled by new investors or acquired by new investors versus long-term holder or old investors. Via the second chart, we can look at the dollar value, because you might have two coins. I might have two coins. Both of us might enter the market. I mean, roughly at this year, or I would enter like 2 years ago. We entered the market at two different times. The number of coins we have is the same. So both of us are, let's say, long-term holder. You bought it last year, I bought it 5 years ago. By the look of it, both of us are long-term holder, and we're going to be counted as long-term holder. And when we look at this blue line, we are treated equally. We are all categorized as long-term holder. But when I bought my coin 2 years ago, I bought at a very lower price than yours. So the amount of energy, amount of profit locked in my two coins is much higher than yours, even though we are literally long-term holder. So throughout this metric, which is realized cap hodl waves, I don't like to stick to the technical names. I want to just tell you what does that mean. This chart measures the amount of profit that been locked by short-term holder or long-term holder. So for example, here I just turned off the long-term holder age bands and only showed the 0 to 6 month. When we say, for example, 60% of the wealth locked in the Bitcoin market is in pocket of short-term holder, we mean all that profit we just talked about. Let's say my coin, I bought it at 20,000, you bought your coin at 40,000, and today is the price is 60. And my coin right now has 40,000. If I sell it today, it will release $40,000 of profit. If you sell it, it's going to release 20,000. So that's the money that is entering the market. So new investors, the money that been entered to the market by new investors, we can measure it. Like the recent buyers, the new investors that who entered in the market, how much of that money that was injected into the market is owned by them. You know what I'm trying to do here? Measuring the amount of wealth locked into the market, not coin, wealth that is locked in the Bitcoin market, and divided by the owners. How much of it is owned by short-term holder, how much is by long-term holder. You could see historically, more than 85% of the total wealth at the moment that we measure these metrics was owned by short-term holder during the market tops, like 2018, 2017, sorry, or January 2018, or 2013, 2011, and 2020. 2021 it was around 85 and sometimes around 90. In this rally, this peaked around 55, 58%. What does that tells us? It means this rally was okay. It was a long-term rally, but the new holders, the new buyers, even though it was sharp by at the time that ETFs launched, actually you can see this metrics just was skyrocketing, like 2021, early 2021. You could see the demand was there, but as soon as we hit 74, that started to decline, and we didn't have as much as previous bull markets opportunity or time window to do that rotation. So the demand got exhausted fast, and you could see after 70, 74, the short-term holder share from total wealth in the market is declining. Why? Because they are becoming long-term holder. So when we see this thing is rallying, is a sign of market heating up. When this one it goes down, that means the new buyers are not entering market at the pace they used to. So you will see, okay, the market is showing some weakness. This is an indicator of when it's increasing, that means the appetite, the interest in buying is high. When it's declining, that means hodling is happening. The new investors are not entering. Whoever decided to stay in the market is becoming a long-term holder after 6 months. So this cycle of this cycle of money moving from long-term holder to the short-term holders pocket and vice versa is actually visualized here. In bull market, short-term or new buyers enter the market, start to buy, the wealth, the share from total wealth in the market increases. In the bear market, they start to spend. Some of them get out of the market, and some of them stay in the game, and their coin start to actually become a long-term holder. The coin is getting older and older. Therefore, because the new investors are not entering, the share of new investors from the total wealth is declining. So here you can see the cyclical behavior of these short-term holders and see how it is correlated with price. You could see their appetite, their interest in buying is what creating the bull market. It is an obvious concept, but here we showed it via a chart, which is realized cap hodl waves. So these two charts justify why the short-term holder are important. Do you have anything, Sina, on your mind that you could ask, or you think I missed in my explanation?
So I was just wondering if you can show us the short term only. So
Yeah,
that I'm interested.
That's short term only.
All of them are short. Okay.
Yeah.
Okay. What if you switch to long term?
Okay, let me turn off the short term. These are the long term.
Okay.
Yeah.
Okay, because I was trying to understand, like, if we can infer anything from the timing of these peaks. But the long-term books actually go meet the bottom when the price tops, and it's completely reversed when you look at the short-term holders.
Yeah, it's obvious because the long-term holder in the bear market are literally the ones that are staying in the game. That's why their share from total wealth in the market is skyrocketing. And short-term holders are leaving the market or getting capitulated or waiting long enough to become a long-term holder. That's why in the bear market, you could see a really huge peak in long-term holder or long-term investors share from total wealth in the market. So that rotation of wealth is really obvious using this metric. But my point is, look at the jump, look at the change of sentiment after early August. Early August, you could see this skyrocket. That means if you look at 6 months before August, it was almost around the time that ETF were launched. You could see when the ETF launched, and they were short-term holder because the ETFs started in January. They were short-term holder. After August, they were classified long-term holder. This jump in the long-term holder share from the wealth in the market shows the majority of those ETF buyers are long-term holder, obviously, and turned out that they are super diamond hand. You could see their share from the total wealth lock in Bitcoin network is skyrocketing. So their long-term holder are not joking, because usually when we hit the bear market or it starts to decline, it declines, and during the rally, then we enter the bear market. But it seems it's changed this time. It could be different, actually. You hear that sentence a lot, but it seems already we've proven it is different this time. Like long-term holder.
Even though the price has been weak and we've been just slowly bleeding, in a range, but mostly going down. But the new money that ETFs brought in, they were actually long-term holders, and they haven't sold, and they have now graduated to the long-term holder level.
Exactly. And that big jump you see is exactly that reclassification of ETF buyers to a long-term holder after 6 months. So let's look at that buyer side or demand side.
So people like Jim Bianco that say all these ETF buyers are degen short-term people. That's wrong then.
So far, on-chain data says so, but we don't know. Maybe something happens and they become degen. But so far, no, they have been diamond hands since day one. Yes, there could be some sell-off. I'm not saying every single of them, but on aggregate, when you look at them, they are super diamond hand. Like they are the, I don't know what they call them, chats. They call them true believers. Yeah, but they are in the game for real. They're not just looking at the 10% profit margin. Oh, let's get out. That's the nature of their behavior. That's what the on-chain data shows until now. We don't know about future. To just emphasize and confirm the fact that short-term holders are important if you want to speculate about short-term or mid-term market movements, I have to show two other charts quickly. First of all, on a daily basis, we have between 500,000 coin to sometimes around 2 million, because in late 2020 we had 2 million coin moved per day. But I mean, on a daily basis, if you look at the number of coins moving around, the red color is showing, let me actually open the chart to show a maximized one. This is a 90-day moving average. Just by looking at it, you can see the red is absolute. There's a delay in opening charts, right?
On different platforms, yes, but not for us.
Okay, perfect. So you can see the red bar, I mean the share of the red color, which is the short-term holder, is absolute dominant when you look at versus the tiny blue line at the bottom. So what it tells us is when denominated in Bitcoin, the number of coin moved per day, more than 95% of coins moved per day is actually done by short-term holder. Obviously, because they're short-term holder, like I said, they are more price sensitive. Long-term holder are in the game for long-term. That's why they're moving the share of their movement from total movement. When we measure it by Bitcoin, it is really small. So the majority of coin move around is by short-term holder, if we just count the numbers. The same time, interestingly, when we look at the amount of profit and loss realized per day, remember, I could sell one coin today. You could sell the same number of coin today, like one coin, but I'm realizing 20,000 profit. You could realize 40,000 profit because the time we bought, the cost basis is different. If we measure the profit and loss, around 50%, especially in the bull market. Let me turn off the short-term holder. In the bull markets, 40% or 50% of profit being realized is actually realized by long-term holder. Even though they're moving 5% of the coins, they are responsible for up to 50% of the profit that being taken. I mean, during that rally or that point in the cycle. That what tells us one thing: Bitcoin is acting as a store of value. That's in just real time. They hodl their coin. They're moving and responsible for only 5% of coin moving around, but that 5% have enough profit in them that is responsible for 50% of total profit and loss moving in them throughout the daily movements to the across the network. So that tells us the long-term holder are the one that realize the profit. They release the profit in the bull market, and they are the one that release majority of loss in the bear market. But the short-term holder, if I show the short-term holder, they are 50% as well. Look, the short-term holder, they are in terms of profit and loss, they are the one that realize up to 80 or 70% of the loss in the bear market, and they are almost responsible for about 50% of profit. So even though they were moving 95% of the coins, BTC around, they are responsible for 50% of the profit. So they are not as significant as long-term holder when it comes to profit, but they are significant enough to be actually looked at and be given a weight when we are doing an analysis. That's why I really want to show you how the long-term holder are actually moving small amount of the coin, but they're realizing a huge amount, close to half of the profit and loss. Short-term holder at the same time, and focusing a short-term holder or new investors is going to help us to see when this cycle are being formed, when they are moving a lot of profit. See, like close. The red line, the red bar, I should have described it. The strong red is actually profit. The low, low opacity, the weaker red is actually the loss. So you could see in the bull market, the short-term holder are responsible for 57 of the profit, and they are actually realizing around 3% loss. And that amount of profit is a red flag. That means they are realizing too much profit, and market is close to be exhausted. And in the bear market, they are realizing almost 57% of total profit and loss, and around 5% profit. That means they are capitulating. They are realizing too much loss. So looking at this change in the share of new investors from profit and loss, again, we can see when the market cycles are being formed. These two charts are telling us why the short-term model are important. They are the ones that are forming the cycles or midterm tops and bottoms by realizing too much loss or realizing too much profit.
Can
This
you
is
bring
one.
back? Can you bring back the long-term people as well?
Sure.
Okay. So when we are close to the tops,
Yeah.
I want to just compare the behavior of these two cohorts. So what happens is when we're close to the top, everyone is realizing profits. Okay.
Yep.
But
Yep.
most of the profit is being, or maybe half and half, or perhaps like a little bit more than 50% is for short terms.
Yep.
When we go to the bear market, yeah, so short term people this time gain a bigger and bigger share of the loss
Yep.
that is being realized. So everyone is realizing loss because even long term holders, their price has gone down significantly. So maybe they have to sell as they realize a little bit of loss. But now you will see short term holders realize a lot of losses. So this
Yep.
relative strength of loss between short and long term holder is a very good indicator to me, seems to me.
Right on. Yes, we can actually get into this in future episodes together. But you're right. Looking at the ratio of the profit and loss between these two cores is a great indicator of spotting cycle tops and bottoms. It's not going to show you where it is, but it can tell you with a high probability, possibly the tops in being formed or bottom being formed. It is a great indicator. But today we just want to show how we can focus only on the short-term holder. But you're right. Using these two, we can create a really beautiful indicator that has actually requires its own episode. So far we showed, let's recap what we showed. We showed there is a change of hand. The Bitcoin are changing hand in the bull markets. And we showed the share of the short-term holder new money or new investors are growing during the bull market, obviously, but it picks out between 50 to 80%, as we show in the realized chart, realized cap waves, and we showed by the volume of the coin moved around per day, or by the volume of profit and loss, short-term holders are responsible for 95% of the volume and close to half of the profit and loss being realized during the bull and bear market. So it's really interesting. They are really effective. That's just what was our intention, to show their effect. Now we know they are, the demand side is responsible for forming the tops and bottoms. We want to use the indicator that are attributed to them to create an indicator that I just showed you at the beginning of this episode. How we can do it? If I want to summarize on-chain in one sentence, or like the majority of what we're trying to show in on-chain is looking at the incentive of the investors, if they are in profit or if they're in loss. Looking at incentive, the amount of profit and loss they are sitting on is the incentive that determines their next move. And then look at their behavior or reaction to that incentive. If they are in extreme profit, how they're reacting. If they're in extreme loss, how they're reacting. So we look at the incentive, then look at the reaction. Then combining these two, we can find the moments in the market that they are extremely profitable and they are spending like crazy and exhausting the market by taking too much profit. And also we can look at the bear market's bottom and see when they are sitting in absolute loss and they are capitulating, realizing too much loss, And that's actually a definition of bear market bottom formation.
So let me.
Yeah.
This was a very important point. Let me just emphasize it. We now, using on-chain data, we have the ability to see how much unrealized profit or loss people have accumulated, and then also by different cohorts. But that's
Exactly.
not enough to predict what's going to happen. You might have a lot of unrealized profit, but you may not touch it. But
Yep.
once it reaches an unsustainable level where you see like you have so much money available, you get even more incentivized to sell some of it. And when you begin selling it, another metric can capture the selling behavior. And so basically what you want to see is for trend reversal, what you want to see is a lot of unrealized profit or loss accumulated, but also you want to get the signal that shows when people are actually taking action to sell or buy.
Exactly. So that might look so like simple, but measuring this by on-chain data, it is really cool. Right here, like in the chart that I'm showing, the first one is MVRV for short-term holder, and the reason we are just showing for short-term holder, we just explained it because they are the one that forming the tops and bottom, both cyclical or local. MVRV is a ratio between the current price, and the cost basis of the specific cohorts of investor. Here is short-term holder, but like you said, we can measure MVR for long-term holder as well. So when the ratio is above 1, that means there is unrealized profit growing. The ratio between market price to their cost basis is above 1. The market is giving them a profit margin. When the number is below 1, that means the price divided by the cost basis is a number below 1. That means they are actually experiencing loss. The unrealized loss is growing. And as you can see, and like in 2017, 19, 2020, around 1.5. That means when by average the short-term holder were sitting on plus 50%, the market started to enter euphoria. You could see huge short-term jump in the MVRV. That means market got deviated from the cost basis, and then market start to experience a correction. How many times we can see this? It's not predictable, but you can see usually the big jump in this metrics, which is equivalent of unrealized profit of short-term holder increasing, is where they are incentivized to spend. It's the half of the story, like I said. So MVRV is showing that unrealized profit going up and down. But when we put this next to another metric, which is called SOPAR, it's a short name for spend output profit ratio, or if I want to say it simply, it looks at the price of selling today. Remember, it's an action. If I sell my coins today at 60,000, 62,000, and my cost basis is 31,000, for example, there is a ratio of 2. The SOPAR is going to show you 2. This is an average for short-term holders. You could see during the crazy moments that we had a jump in MVRV, for example, here, they start to spend. You could see the ratio of the spending price divided by the cost basis is going up. And it's only for the short-term holder who are spending, not for the MVRV is for all short-term holders because it's measuring the unrealized profit. This one is the realized profit of the ones that obviously spend their coin. When these two are having a strong confluence, there is a high potential that market getting exhausted because they're taking
this is basically like MVRV shows a balloon forming, a lot of unrealized profit, but this shows us the explosion point when people actually begin to sell.
Exactly. You put it in it was a great example. Now we have these two concepts. We want to put it next together. How we do it is exactly what we're going to show you as a closing argument. I mean, the fruit of all this explanation and justifying the importance of the short-term holder, it was because we wanted to make this in an indicator. In this indicator, we are measuring the difference between the cost basis of the one who are spending, which is the orange color, the difference between their cost basis and the ones that are hodling. it's a little bit complicated, but let me put it this way. When the ones among the new, the ones that are actually considered new investors, let's say we have 100 new investors into the market in general, it's in order of millions, but let's take 100. And when the price goes up, the one that are spending could be 5 or 10 of those that 100 investors. When they start to spend and their cost basis of the one who decide to spend is way above the cost basis of the hodler or the unrealized profit, that means they are too confident in the market. So measuring the difference between these two, the one that are taking the action and the one that are in general not moving their coins, all investors, when this is getting too much deviated from each other, that means it is too much confidence. Market giving too much profit, too much chance to the short-term investors, and if the cost basis of the one that are spending is rising too, that means they're reacting. They're exiting close to the market price, and that's a sign of that confidence we just talked about. They are exiting, and the profit is huge. That's a textbook definition of the tops. The same time, when the one that are spending have a cost basis below the cost basis of all short-term holder, that means they're losing confidence. They are the one that are spending. They have a cost basis of below the cost basis of all short-term investors, and the reason they are spending is because they're capitulating. And when the capitulation or deviation between these two cost bases, among the deviation of behavior between the one that are hodling and the one that are spending, when that one grows, that shows the market is underconfident or losing confidence in the market. By measuring this deviation and normalizing by price, you could come up with a metric that actually fluctuate between minus 30% to 40%, or recently the band is shrinking to 25 to 25, so 25%. So when the cost basis of the one that new investors who are spending or reacting is getting deviated from the hodlers, the short-term holder who are short-term holder but they're not spending, when the deviation in their behavior or the cost basis is increasing beyond 25% of current price, that means they are exiting too fast. They are reacting to that profit way faster than early stages of bull market. So this indicator,
can we say this is interpreted like this? This is how much profit are the short term. This is all short term, folks.
exactly.
So when you are in the green zone, it shows you the short term people are cashing out, realizing
At profit.
Yeah, and that can be good or bad, right? In the
Yes.
beginning, when they're realizing profit, it's all fun and games. That's all cool. That's exciting, but it reaches a point where almost all of the profit is out, and the sell pressure is now too much, and other parts of the market can't absorb it, and then we go the other way. When it becomes red, that means short-term holders are exiting at a loss. So that's a strongest indicator of, hey, I'm done with this market. I'm willing to realize a loss and just take some of my money back.
Yep. Yeah, and that behavior does continue as a experience. Our experience with the market shows that behavior of realizing loss continue and intensifies as the market continue. The prices continue to drop, and we experiencing the exhaustion. The price weakness. As the weakness continues, that realization of loss continue as well and intensifies. But as soon as it reach to a certain level, they realize too much. They're actually exiting the market, flushed out. That's the beginning of the bottom formation. So this is the beauty of this metric, is gives you the ability to spot the local and cyclical tops and bottom. That's the beauty. Let's focus on a recent cycle. If you look at the post FTX, FTX was the let's focus in. Let me open it separately. Okay. Let's look at last 2 years, for example. 2 years. Okay. The FTX.
By the way, this is you. The chart you created yourself, right? It's not available for the public through Glassnode.
Yeah, But we put a couple of articles that are available at insideglassnode.com. We put the link in the description. You can go look at it, and the people who have an account with Glassnode can look at this chart. But it is not a metric per se that we put it individually. I mean, under the studio. This is a custom made that people can look at it in dashboard. But you have to have the link. We will put in the description. And if you have any question, we will be happy to answer. If you look at the post FTX, FTX was almost the end of the bear market. You could see this indicator was dropped to 15%, minus 15%. Then early 2023, we saw this one is turning positive. That means the bull market was giving the opportunity to short-term holder to realize a little bit profit, and that was growing. As you can see, there is a yellow color that is for the indicator being between minus 5% to 5%. That's close to the zero, so we color-coded yellow because it's the equilibrium. It's when most potentially there is a chance that the sentiment changes. You could see it's yellow and then it start to turn green, and then you could see it is growing because the margin is growing, the profit margin is growing, the unrealized profit is growing, and they are realizing it slowly. And then we reach around like it was, I think, March 2023. You could see market entered a weak regime. You could see the regime change a little bit, and that's actually where they were overconfident. This metric was showing plus 20% profit margin being taken off the market by these new investors, and this was causing, and it was exhausted. It could be because of an external reason, whatever was the reason. The price action showed some weakness, and that caused the lack of the confidence of this short-term holder in the market decline and vanish. You could see the weakness in the confidence indicator. That continued. Then again, when the price got close to the cost basis of short-term holder, you could see the profit margins closer. They stopped selling. They didn't show the appetite to realize too much loss. They simply stopped. And that's the beauty.
Basically, they got rid of all of their profits.
Yes,
they sold everything. Okay.
Yeah, and they didn't. That's so in bull market you see a couple of times that bounce happens. The price get close to the cost basis, the profit margin get narrow, but they're not willing to realize any loss, so they stop selling. The market enters a local equilibrium, then it can get refueled, and the bull market continues. We see that kind of bounce back a lot in the bull market, but there is a moment in the bull market that you see they are too much exhausted that they start to realize loss. So yeah, in 2019, for example, 1, 2, 3, it's not bouncing, but it's getting close. 4, 5, and then for the 6th time, when they got close to their cost basis, they start to realize, because the market was dropping. It was China ban. Usually an external factor incentivized them to realize beyond their cost basis and realize too much loss. Or I think it was the Luna. You could see Luna happened. Then the market tried to bounce back, and price got close to the cost basis. They saw the opportunity. Oh, let me get out at my cost basis, and just, this is bear market. And the market didn't have enough juice into it to keep continue. You see the market continued the bear market. I mean, the sell-off, and you could see then the FTX happened. Like a lot, it was a crazy bear market, by the way. So this cost basis price model is really strong in terms of predicting most of local tops and bottom in bear market and bull market. But the moment you break below and break above of it, that is a strong indicator of shift of sentiment in the market. In the recent 6 months or recent 1 year, let's say, you could see a couple of times market reached to the cost basis of the short-term holder and dropped temporarily below it, and then continue rebouncing and breaking above. And this indicator was showing, hey, the confidence is declining. Then since June this year, you could see the negative sentiment. But this, when you measure that negative sentiment, it was not as negative as like COVID crash. It was not as crazy as China ban. So yes, there was a lack of confidence in the market, but it was not as strong as or as significant as previous bear market. That was a great sign because they were resilient. They had the chance to exit or show some weakness. When the market showed some weakness, exit the market and capitulate. But they refused to capitulate. Some of them capitulate, but it was not as significant as previous bear market. Because this is around like 8%, 9%. Usually when we see that indicator breaks below minus 10%, like around here, here, strongly and sharply, that is usually the beginning of a midterm to long-term bear market. But so far, you could see market is bouncing around the cost basis of these new investors. And the reason we are not breaking so far below that sharply is because as soon as price get close to their cost basis, they refuse. They don't show no appetite to realize too much loss. They simply just sit aside and turn to a bull, long-term holder, as we showed. That's the change of nature again. The new buyers close to the top or after top are not that price sensitive as what we saw in previous cycle tops, which is interesting. So far, they are acting differently. So far, they're not showing any interest to get out at too much loss. A market is starting to reach to equilibrium really fast. It doesn't need to drop 80%, 40%. And that is really interesting. There could be a lot of reasons. ETF could be one of the biggest reasons, but also it could be other investors as well looking at Bitcoin differently. And no matter what, this indicator is going to be agnostic. If they decide to realize too much loss, you could see this metric is dropping crazy. And that's the beauty of this metric. And after this long session, I hope you could see how we can measure that lack of confidence or overconfidence structure in the market using on-chain data, not measuring these, because usually we measure these things from our perspective. Our subjective feeling about the market is what we usually use as a reference to say, oh, market seems too bullish, or market is there's too much confidence in the market, or they're losing their confidence in the market. We usually look at the price itself, but this metric is looking at action. Even hodling is an action. You're taking action to hodl the Bitcoin, or you're spending. That is really interesting. And we focus on the demand side. What is the demand side sentiment by looking at these two metrics? Hopefully that was like clear, but we will be happy through 20 First Capital channels. Please ask us, ping us. Me and Sina will be happy to answer your questions.
Yeah, so basically the takeaway from here is short-term holders in this cycle have been resilient, and when they had unrealized losses, they didn't choose to sell, and they have confidence that the trend will continue and the price goes up, and I think they'll be right. What do you think?
Yes, so far they've been right, and I would say election would be a really, really interesting day. We will see, because I believe one of the reasons, yes, the nature of the new investors are changed, but also the number of events and expecting people are expecting World War III. So everyone are waiting for this election to happen. I think after election we will see this band is going to be either broken above or low. My bet is on upside because time is pain as well. We were not entering bear market by the some might not define this as a bear market because we just break down 20% or 10% from the all-time high. 26% I think was the maximum. We didn't see 80%. But at the same time, we have been in this range for almost 6 months. That is pain. So time has been pain here. I think we're in a midterm bear market looking at it. So that is enough. I think market is ready unless something macro happens and the risk indicator turns off, and we'll probably see some breakdown. But so far, I think it's promising, and I'm betting on upward.
Yeah, time is very important because time puts psychological pressure on short-term investors, and if they're still with us after 6 months, it's a great sign. I did want to show quickly this another chart just to add a final twist here. This is my volatility adjusted MVRV metric. We were looking at a regular MVRV in your presentation, but I adjusted the MVRV by volatility to arrive at an indicator that kind of gives us a simple way to measure how hot or cold the market is, kind of complementing what you were saying. This metric goes from 0 to 100, and when it's closer to 100, we have always had the cycle tops, and around 0 is the bottom of the bear market. Now you can see on this chart, we didn't go to a typical bull market top when the ETFs arrived. So we went up quite a bit to about 75%. And it was high, and the market corrected. And now we have kind of cooled off quite a bit, actually below 40. And even though we've had quite a bit of price increase lately, but this metric that's capturing the level of unrealized profit in the market, it's pretty cool. So this kind of confirms what you were saying, that the market is in a cooler state, just waiting for the next stage. And we don't see signs of euphoria yet. We don't see signs of bubble forming. And several of the models that you can use to analyze the valuation of Bitcoin, they all basically say that we are in a very orderly market. And that's a very interesting development. Market has been a lot more volatile in these stages in the past cycles. But it'll be very interesting to see what happens in the next couple of months. Big things might happen. As you said, election is coming up. Geopolitical tensions are developing, and they can always turn into a more significant event. And we will also kind of pass through this phase of uncertainty about the economy. So we're always getting a mix of positive or negative news about the economy. Numbers look good, but there's also some underlying weakness. And towards the end of the year, it will be very clear whether all these signs of weakness are moving in the right direction or in the wrong direction. So and with new president, it feels like we should get a lot of uncertainty taken away, and the market should get ready to move. And we are already actually having some moves. Gold is approaching all-time high. Bitcoin is following, and stocks are up as well. And I just think the end of the year is going to be very good and epic. So let's see.
Yeah. Really happy to update the people who are interested in these metrics. I mean, more frequently throughout our sessions in future as well. Like if you have you see interest among your audiences, we'll bring up this chart, because we're going to do a couple of these educational sessions, then come up with 4 or 5 metrics, and when people are familiar with them, we're just gonna keep updating them. That would be great plan for 21st Capital audiences and readers. It would be great to do it that way.
Awesome. Thanks a lot, Z. Really appreciate your analysis. This is top notch. This is extremely valuable, and we are lucky to talk to you about these things, and we'll continue to discuss market developments in the coming weeks.
Oh, my pleasure, mate. I can't wait for the next session.
All right. See you all later.
See ya.